Hi, I'm Jamie Uppenberg, your host today and a member of the Carl team. We're chatting today with Marcus Bueno from Ascent Systematic Advisors, Quantitative Hedge Fund. We're going to find out today what makes this fund so successful, some fund history, and what's important for investors to know about this fund, our usual first conversation with an upcoming fund. We are Carl, digitally offering quantitative hedge fund strategies as fund of funds, packaged and data-driven delivery to accredited investors. Carl is offering Denali, which is based on the Ascent Systematic strategy. So Denali will be offered on our platform in the coming weeks, and we are very excited to have Marcos. Marcos is the founder of CIO Ascent Systematic Advisors. Prior to starting Ascent, Marcos was with Argon Capital and the London office of Graham Capital. He's managed a multi-asset, multi-strategy startup fund that he turned into a family office, and a leading trend-following systematic and global macro fund close to $1 billion in assets. I'll add that Marcos created what is now Ascent strategy originally for himself, and he didn't intend to provide it to others. Well, I'll let him tell you how that came about. Hi, Marcos. It's great to be chatting with you today.
Jamie, how are you?
Good. So we always start off with what has made Denali successful so far. And what that means is if you weren't managing it and you were just reviewing it, why would you put it and keep it in your portfolio?
Well, it has performed really well. So that's that is an important reason why I would keep it. But I love it because it's something I did for me, as you said, and it works mostly because it takes advantage of things that are timeless in the stock market and timeless in the risk, in the management of money, in the business of money management. And those two things are trends happen in stocks, and what this strategy does is benefits from trends. There's always some stocks that are trending up. And two is that the truth in money management is that to make money, the first thing you need to do is not to lose it. So this strategy is very, very strict when it comes to that. And it never lets anything get out of hand. The moment a stock stops going up, and it doesn't make money, then it cuts it out. So in the end, what it has is a portfolio of stocks that are going up. It's sort of a little bit Darwinian in that sense that it gets into the stocks that are going up and it keeps them as long as they're going up. And when they stop going up, it cuts them out. So basically, it's sort of like survival of the best, and it's all the portfolio. It's just stocks that are going up, and that tends to be a nice thing to have.
Right. It looks like it's working. So it's from when Denali started, was this how you started the strategy from the very beginning, sort of this survival of the fittest? That I heard you started really for yourself. This is how you started trading for yourself. Was it always that way, or were there any changes you've made since you've started?
The philosophy has been the same from the beginning. There have been some tweaks, mostly on the money management side, just to run a tighter risk management process, but the philosophy is the same. And it was the same from the day one, but it basically took me 15 years to get there, in the sense that I have been trying every other way of investing before, value, macro, long-term, short-term, day trading. And what I found is that ultimately what works in stocks is this. There's a bunch of things that are happening in stocks, but we know that they trend, and we know that if we don't lose money, we'll end up making money. So it sounds very simple, but it sort of like takes a long time to come to this epiphany that is the way to make money.
Not only just the way, but to make the strategy that'll do it, right?
That can accomplish exactly. So the idea is not complicated. It's just buy the things that are going up and keep them until they stop going up. What is slightly harder is the implementation. That has to be subtle. It is very easy to say, okay, buy the stocks that are going up, but actually, how do you define that? How do you find those? You have 5,000 stocks to choose from. How do you choose the 25, 30 that are the best among 5,000? We're talking about less than 1% of the whole universe that we're going to take. So that is where sort of like the value comes from, is like, how do we do this? And then the other thing is like, it's very easy to say don't lose money. It's harder to say to actually tell a computer how to do that. So So that the implementation is where the real value is, because the idea in itself is it's very simple and it's easy to understand.
Yeah, some of our best strategies come from simple concepts, but getting the systematic technological part of it functioning really well with a simple concept is sort of where rubber meets road, right? And I think, historically, investors will see Denali, at least historically, has been able to do that. So what is this about? You did this for yourself, and you didn't really intend to have a big ascent, strategy. How did it come about?
Yeah, the story is that I had been managing other people's money for a long time. So I got tired of that. And so just, and I, because most institutional investors, they have a number of constraints. They are looking for something very specific that needs to fit into their boxes, right? They have the macro box or the long-short equity box or whatever box they operate in, and they're very siloed. And I realized that there is an opportunity to make money by getting out of the box, basically, things that are less explored, that there are some inefficiencies out there that can be exploited, but that wasn't really something that institutional investors would be interested in, because it wouldn't fit in the boxes, even though it made more money, because it was hard to fit within their framework.
Right.
They were not interested. So but I knew that this is the way I wanted to do it. So that's why I decided to do it for myself. And long story short, there are some other investors that were not subject to the same constraints that sort of like found out about what I was doing, and they asked me if they could do it with me.
That's great.
And I said, yes, okay, fine. This is how I manage my money. If you want me to do it for you, I can do it too. And that's how it started. And then it grew. It grew from there. And I think the institutional investors, generally speaking, will have a harder time investing in the strategy, but that's not necessarily a bad thing for people that want to make the returns, because the fact that they're not necessarily in it means that it's different.
It's different, right? And I mean, you obviously have a lot of confidence in the fact that it'll reduce an investor's risk from standard indices and yet give them a strong gain opportunity, right? A returns opportunity.
Yeah, because one of the number one thing when I did this is that I myself had a lot of difficulty being invested in sort of like the bull market in equities. It's just it's a character flaw, so to put it, right? I have an engineering background, and I tend to be rational and look at the things that can go wrong. So to me, it was a bit of a difficult thing to do it. Yes. And it was a weak spot in my trading. So the way I did it is like, I knew what I needed to do is basically get on the things that are going up, but remove my judgment out of it, remove my sort of like natural pessimism, if you want. Yeah. Stop getting in my own way.
Yes.
And like so that came through a systematic approach that removes any sort of emotion and bad judgments that I can have, right? It's like it's a ruthless machine. It doesn't have feelings like I do. So it doesn't have emotions, so it doesn't care. It doesn't get married to positions. It will love it as long as it works, and when it stops working, it will stop loving it.
Right.
And that is very difficult to do. Yeah, it would sell. It would. That's very difficult to do for a person, and it's difficult to do for me. So that's why I think the machine does it better. Now, but the point that I wanted to make is that the number one thing, given my character, the number one thing I wanted to make sure is that the models are not going to own anything that is going down. And that is sort of like hard-coded, is never going to happen.
Okay.
And then we'll see what happens on the upside. It turns out that when you don't lose money, basically you keep more money for the good times, right? So when you keep your pot, then you have more money to capitalize on the good times. So markets have good times and bad times. The key is during bad times not to lose. So then you have a lot of money to make money when the good times come along. Right. If you lose all your money during the bad times, then you don't have money to make money during the good times. So that's why the returns have been so good, because we have been very good at protecting the capital.
Right, which is a
So
huge part of hedge funds overall.
exactly,
And Denali is pretty strict about it.
it is.
Uh,
That's my goal.
yeah. So let me ask you then, do you have, and by the way, this is one of the reasons I joined Carl and invest in Carl hedge funds is I have the same challenge with just investing in the market, just finding stocks or investing in the indices, the prospect of the volatility that eventually it's going to have a bad day is tough for my character. So with that though, what have you found any challenges when the market is when the market's going down? Because you're still trying to find stocks that are going up, but if everything's going down, and we do have funds that just they'll revert to cash and hold. What kind of challenges do you have in the down markets, or do you think it works pretty well?
I mean, when the markets are down, it's not the best environment. Denali doesn't care about the market as a whole.
Right, right.
It only cares about finding opportunities that meet the criteria for capital deployment. It is, I mean, reflecting to some extent my personality as an investor, it's a very conservative approach. It's like the bar that we need to clear to put money to work is very, very high.
Yes.
Again, we're looking to select 25, 30 stocks out of 5,000. So the bar is set very high. On the other hand, the bar is set very low when it comes to getting out. It's like we're unforgiving.
Right.
If something is not working out, it doesn't matter why or how come we just it's not working out, we take it out. It's like a bad employee, we fire.
Right.
It's like that's it. There's no, and that's one of the values. It has no feelings. It's like it has no issue doing that.
But that means when the market's down, you may not be in 25 stocks,
exactly.
right?
So what happens is that even though the models don't care about the market overall, when markets go down, we may find fewer opportunities. And the philosophy is that if we don't find opportunities that are worthy of risk or of risking our capital, we're just going to keep in cash until we find that that opportunity. So during down markets, what will happen is that there will be a bigger allocation to cash. We're probably going to be underinvested, knowing that even when the markets are down as a whole, there is always some winner in some corner of the market. There's always some stocks that are going up.
Right.
Obviously, when the market is going up, we will see more of those. And when the market are going down, we will see less or fewer of those. And then the model will adjust accordingly. It doesn't make a macro call on the market. It just looks at how many opportunities meet our requirements for capital deployment today. So if there's a lot of those, we will be heavily invested. And if there are not many of those, they will be conservatively invested. At the limit, we could be all in cash. If nothing is going up, we much better be in cash than be losing money.
Yes. And I've actually talked to quite a few Carl investors who say the same thing. They're like, no, if the fund managers think we need to be in cash, then let's be in cash. They would much rather have that for a short period than to over risk themselves, yes, right? The whole point here for most of our investors is they want to be able to have the same or better returns as market indices and less risk. So
yeah, that's a key difference versus the institutional investor. The institutional investor typically will think that being in cash is anathema to what they want to do. They want always to be fully invested.
Working. Yeah.
Yeah.
But,
which
that's interesting though. They still
different.
Want the lower risk. So it's tough times.
Yes. So what it ends up happening with Denali is that when the market is going up, we're going to be invested in the market.
Yeah.
When the market is going down, we're going to be not invested in the market, which sort of like
or invested less, right?
Or invest. I mean, in reality, we'll be invested less, but never invested in something that is going down.
Right. I think a lot of investors would agree with that strategy and would appreciate that a system can do it, right? We don't have a human having to make these calls. So, I mean, Denali obviously has a great historical performance. You've been doing this for some time now. Obviously, you're quite the pro. What about this change going into retail? I mean, I don't know that this would impact you at all. What do you think of hedge funds being offered to retail investors? Does that change how you look at your strategy or your fund? I don't think it would, but
no, it doesn't. What it does though, the involvement of retail, so like we have seen lately, heavily involved in the market. Hedge funds or not hedge funds, what it does, it changes the character of the market. That may be a problem for certain styles of investing that depend on certain ways of looking at the market, because the character of the market has changed.
Right. And if a fund or a strategy depends on the character of the market, they need to be making changes right now, right?
Exactly. So, and that is something that is always hard to do. I mean, I've been in that position, let's say, at the beginning of my career, I was a value investor, right? Value investing has had a tough time because the markets have changed. As the new generation of investors come in and new blood comes in, and there are cycles. That's something that is always happening. And there's these cycles, maybe 10, 15 years, where a certain style works, and then everybody gets onto that style, and a new generation of investors come in, and they change the character, and then the things that used to work 15 years ago doesn't work today. And then what works today will not work 15 years from now. So that is always hard. The good thing about what I do is that it does not depend on that. It just uses these timeless features of the market. It's like there's 5,000 stocks in the US. There is always some winners and there's always some losers. There's always stocks that are going up, and there's always stocks that are going down. So we just focus on those that are going up, and we don't use any sort of. We're agnostic as to why things are happening. We just know that things are happening.
Right. Love it. Okay, great. Yeah, I've heard you talk about your stocks as like hiring your team, and as soon as somebody goes down, you fire them. I think you said that earlier. So I think a lot of investors will agree with you. Really appreciate you chatting today. I think Denali is a very interesting addition to the Carl portfolio, and really focused on returns and growth, right? That's the goal here. It's a big returns and growth strategy. And as you say, it's pretty ruthless about it. And I think a lot of investors are going to be looking for that. So really appreciate the conversation. Do you have a final word for our investors today?
No, just thank you for listening. I would say that this is how I manage my money. And if somebody else wants to tag along for the ride, I'm happy to do that for them. The key question here is that I'm always focused on not losing, and then the making of the money takes care of itself. My focus every day is of how much can I lose from here. I don't want to lose money, and then the rest comes just by itself.
Right. And I can tell you, investors, Marcos likes growing his own money as well, as we all do. So he's very focused on the strategy and making sure Denali continues to work for us as well. Thank you so much for joining us, investors. Thank you for coming along on another episode of Invest with Carl, and we will see you next time. Bye-bye now.
Thank you.
Thank you.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.